The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. And joining us now on Market Talk as we close out the week of trading, we want to take a broad look at where things are, not only in the commodities, but with trade, exports, the overall ag economy, and more. Always good to catch up with our friend David Widmar with Agricultural Economic Insights, and he joins us here today on Market Talk. David, welcome back to the show. How are you, sir?
Doing well, Jesse. Thanks for having me back.
Absolutely. Good to talk with you again. And man, where to start? It's no secret that the ag economy has been feeling the pressure here really throughout the summer and throughout the year. We've touched on this before. Thinking back to some of our previous conversations, you think about interest rates and trade, and there's so many different things we could look at here. Why don't we start with just the overall kind of export picture? I know you guys have done some work in terms of corn export, soybean export commitments here as of the end of September. Frame this up for us. How are things looking? What have you guys found with your analysis right now?
Well, the cure for low prices is low prices. And what that means is we're waiting for usage to kick in. And one of the big sources of variability in usage of corn and soybeans and wheat on a year over year basis is exports. And so what that means is if we're going to see a lot of usage kick in, it's probably going to come from export activity ticking higher. If we're going to see some rationing of demand, we're going to see it coming out of that export. So we've been hoping to see some encouraging news coming out of the export data. So the first article we looked at was looking at those new marketing year commitments. So that's the 24/25 marketing year. That's 6 weeks underway. So it's very, very new here. But what's the pace look like? And the pace isn't the full story. There's still a lot of chapters to be written here, but it gives us a glimpse. And what we've seen is that corn got off to a noticeable start, an encouraging start. Soybeans have been a little bit on the sluggish side, especially trade to China. Now, they've closed the gap between the 1st of September and the end of September, but we have to keep an eye on this. This is not a situation where, I guess, when we see news about trade happening, we're treading water or maybe making small gains. This isn't a situation where we're seeing, new export activity or new demand levels or new we've talked about this before, Jesse. We need to see record amounts of exports, record amounts of usage to sort of keep up with the trend line. It's been a while since we've had to release the usage story, the demand story, but we need to do that here in 2024 heading into 2025 if we want to see markedly stronger prices.
Well, and I think about just the price activity here. I mean, this week alone, we've kind of faded off the most recent rally. That harvest pressure really, I think, has been being felt in these markets just as U.S. farmers harvesting such a big crop in many areas, running out of storage space, things like that. So to your point, as we kind of work through this season's harvest here, we're just adding to that global supply picture here in the U.S. side anyway, aren't we, David?
Yeah, so we have a situation here where soybeans, your listeners aren't going to be surprised by this, a really burdensome soybean ending stock situation. Corn's kind of been the quiet mouse, I think. If we were sitting here a year ago, we were thinking about high 14s, maybe 15% stocks to use. So the 23-24 marketing year did a lot better than we were sitting a year ago today. And now we're sitting at the 24-25 marketing year is, high 13%. And so it's getting closer to that long run average, which is right around 13%. So corn has sort of went from a pessimistic outlook to a neutral. Soybeans have gone from neutral to pessimistic. And we'll see how this plays out. I think we really have to keep an eye on soybeans and usage and just this bigger trade story picture, both, with China, but the rest of the world as well.
Well, and thinking about that, I know you doing some work on the AEI website just on global trade as a whole, and give us a little bit of a deeper dive there. I mean, we talk so much about China, to your point, but it just feels like that the way trade is going, you have talk of potentially tariffs on China and other countries. Say former President Donald Trump gets elected here in November, et cetera, et cetera. So, I mean, just thinking about the global trade picture, it almost feels like we're at a point in U.S. agriculture where we have to think about and look harder at other trade partners and other uses. Am I correct in saying that?
Yeah, that's the conclusion I recently reached looking at this data and writing about it. Um, the last 20 years, you could summarize how good or weak exports have been and even usage by activity with China. And now our work as economists and reporters is going to be more difficult, and even producers and grain traders, because we now have to keep a look on a whole lot of countries, not just the one country who's counting for a majority of the activity. It's a whole lot of countries that are aggregated up to be important. So what we've seen is that calendar years 2024, so you look at the first 8 months of 2024, compare it to the first 8 months of 2023, China's off quite a bit. It's a big setback. It's especially big for corn and soybeans. That data are in dollars, and so you could step back and say, well, what's the price impact? What's the quantity impact? So we have lower commodity prices, but we also have lower quantities going to China across the board. There are some commodities that are doing well, like wheat. Interestingly, wine is also very popular export to China at the moment. It's been up, but across the board, the story has been pretty pessimistic for corn, soybeans, and most meat products exports to China. Now, if you look at the global picture, year over year, 23 versus 24, it's about the same. It's about 1% lower, less than 1% lower. And that's, I think, is a positive development. We have lower prices, but we have higher quantities going out the door. And so, China's off more than $2 billion in dollars worth of trade, but Mexico is up about 1.3, 1.4. And then a whole bunch of other countries are stepping up as well. So it's a lot of Central America countries that are really stepping up that we've seen a lot of trade increase with the last 8 months. So the point here is we're going to have to really update our thinking. We're going to have to stop getting caught up in the pessimistic news of China. We have some diversification going on amongst our trade partners. So we'll see how that plays out in the coming weeks and months ahead, and really the years. This is a long-term story that we're going to wait to see how it develops.
And I think about this too when you talk about that, and some conversations I've had with folks as well. I think about the book from former U.S. Trade Representative Robert Lighthizer titled "No Trade is Free." I need to take a deeper dive into that book, but just that title and that sentiment, you think about the way trade is going right now and some of the rhetoric out there. At the end of the day, kind of makes sense that the adage of no trade is free, at least in my mind, David.
Well, as an economist, the world is full of trade-offs. And so another trade word, trade-offs, is if we do this, then there's going to be the consequences. And then there's also alternatives that we could be considering. And I think one of the realities is that US agriculture has had a long and strong history of exporting a lot of our commodity products. And there's been some shift over time. We've focused away from commodities, so corn going and soybeans, bulk exports of commodities going internationally. We've seen some more consumer oriented goods. So instead of shipping the corn, we're shipping the beef. That's been one shift that we've seen play out over time. I think the other trend that we've seen in our recent memories, 10, 15 years, is we've seen more domestic use of corn through ethanol. That's been a huge source of that. So if you look at corn exports, they've been flat over the last 20 years because of ethanol. And of course, we see the domestic crush situation coming online for soybeans. And so I think there's always this idea, exports are the sort of the easy way to move bushels when we have a burdensome crop year. That's sort of the low-hanging fruit. But long term, I think the question is how are we going to use our bushels here at home versus trade? And I think there's a lot of opportunities to use them here, but we just have to find the right markets and the right places to deploy those.
No, great thoughts. Let's tie in interest rates here. Farm level interest rates in particular. You've been doing some work on that as well. What are you seeing right now in terms of the interest rate environment, David?
Well, it's no secret that interest rates have been going up a lot. So we just want to step back and say, how does this look relative to the last 30, 40 years? And so we see farm level interest rates approaching levels that we hadn't really seen sustained since the early 2000s and late 1990s. And there's a lot of common themes that are going to come up here. And one of those themes is that interest rates are much higher than they were in recent memory, but not nearly as high as we saw in the 2000s or even 1990s. The other thing we've been monitoring and keeping an eye on is the type of loan is also driving the interest rates. Typically, you see higher interest rates for farm loans, so farmland loans, farm mortgages, real estate mortgages. Uh, but right now, recently, that data, we have slightly lower interest rates on real estate loans compared to operating lines of credit. And this is this uh, yield curve inversion we've been hearing a lot about. The yield curve maybe is starting to uninvert itself, maybe revert back to something closer to normal. That relationship is always moving around. But I think one of the takeaways that I think is really important with the Fed lowering interest rates there in September is that no one is expecting or telegraphing or forecasting a return to those ultra low rates that we saw between 2010 and 2022. That is not being telegraphed by the Fed. The second thing is, while we might see lower short-term rates, long-term rates like those real estate loans that we just talked about could be sticky. That yield curve inversion basically meant short-term rates went up a whole lot more than long-term rates. And now that the Fed is lowering short-term rates, those long-term rates could remain high. So we got to keep an eye on that. Of course, farm debt is about 80% real estate. And so, I guess 70% of debt's real estate, 80% of the assets are real estate. So we have to keep a really close eye on real estate out there. It's a really important part of the economy. So the farmers are usually more impacted by long-term interest rate trends, more so than the Fed moving rates 50 basis points, as we saw in September.
David Widmar with Agricultural Economic Insights joins us here today. And you mentioned that 70-80% of farm debt is tied into real estate. And I think that is, to your point, very key to keep in perspective. We think about some of the drops in ag equipment purchases and new infrastructure and all these sorts of things, when at the end of the day, a lot of farmer rancher money and assets gets tied up into real estate, into farmland, et cetera, et cetera. And you think about farmland rates. I mean, I haven't seen a whole lot of wholesale changes there in the past several years, David.
Yeah, we got a great article. My colleague Randy Dickhoot did a great job of summarizing. We've seen some slowdown in the farmland, maybe some negatives if you think about changes over the last 6 months, but still, year over year changes have been positive. So it might be another 6 to 12 months where we see a big adjustment in the farmland values, or noticeable adjustments in the farmland values. But there's been a bit of a pause there. I think there's one more point here that's really worth keeping in mind for the farm economy. We saw the USDA's latest net farm income estimates, and this is a situation where average is very deceiving. So the farm income across the whole farm economy, or the average, doesn't look that bad. But when you dissect it by commodities or by regions, we have corn, soybeans, wheat that are in a really tough situation. And a lot of livestock sectors, not all of them, but especially cow-calf producers, have really high farm income. And so we have this farm economy with two tails, or two outcomes. And so some regions, such as the Corn Belt, are going to see a lot of financial stress going into 2025 because it's heavily focused on hogs, corn, and soybeans, and that's been not a positive development for any of those commodities. But when you move into the Great Plains, where there is more livestock, cow-calf producers, or you move to other parts of the country, there's more fruits and vegetables and specialty crops and other types of livestock, the farm economy isn't doing nearly as poorly, or isn't struggling nearly as well. In fact, cow-calf is probably having one of the best years that we've seen in recent memories. And so I think it's really important to keep all of this in mind, because the farm economy is easy to talk about in the data, but it's hard to, really drill down when we're talking about farm level considerations. There's a lot of differences going on through the farm economy today. It's important to keep that in mind.
Well, and to kind of sum that up and sum up everything we talked about here today, I think as farmers put pencil to paper here, as they wrap up harvest towards the end of the year, and I'm sure you and I will talk again before the end of the year, but things to really keep in mind as farmers are looking at their individual bottom lines, talking with bankers. I mean, from your economist perspective, what do they really need to think about here as they start thinking about end of the year planning?
Well, the first thing to do is make sure we're making 2025 decisions based on 2025 realities. If you think about the corn market, for example, the soybean market, the new crop prices for 2025 are better than the new crop prices for 2024. So we want to make sure that we're updating that type of those lines of thinking. The other thing to also keep in mind is that there is a lot of global uncertainty going on out there. There's a lot of trade uncertainty. There's a lot of global uncertainty. And I think the other reality is we've sort of budgeted for, in recent memory, we've budgeted a much better financial situation than we saw when we actually ran the combines in the fall. And so we've seen commodity prices trending lower throughout the growing season. So maybe that's time for us to update our marketing plans and make sure that our marketing plans are capturing some of that reality that we're budgeting. The last piece of advice I have is to get really focused on our costs. That's easy for economists to say, but really drill down to those fixed costs. Fixed costs are going to account for over half of all your production costs. It's easy to focus on input prices such as hay or seed or fertilizer or herbicide. But in most cases, it's the land, it's the family living, it's the machinery, it's those overhead costs that are really going to drive our success as an operation in the long term. So get a handle on those, measure them, and get a plan to manage those for the next few years to come. And that can really set us up for financial success in the long run.
Great thoughts. I know folks can find more online, aei.ag. You guys have free articles. You have the premium site as well. A lot of resources available on the website, right, David?
Yep, aei.ag. We have a weekly newsletter that's available. And as you said, there's some free articles and there's also content behind the paywall as well. So be sure to check that out.
aei.ag for more. David Widmar, Agricultural Economic Insights. Great to talk with you again. Thanks for joining us on Market Talk. Appreciate it.
Thanks, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.